Well, happy Saturday, folks. I wanted to dive down today into talking about hyperinflation and how it is potentially going to affect your stock portfolio. This has been a fascinating conversation, as many of you may be out grocery shopping or like us, kind of just walking around and seeing some kind of construction projects going on that have been halted because obviously to progress when lumber prices are at absurd highs is insane. And same when you're just looking for basic fruits and vegetables right now, whether you're talking about strawberries. We were just having a discussion today about watermelon prices have doubled. And I know this is going to be kind of one of these fixed conversations where it might be a little bit off putting, but I don't want to try and do it to that nature because obviously I'm still investing in the market. But I want to talk about the impacts that this is going to potentially have on your portfolio because I feel like we're in this chaotic eye of a storm where everything has leveled off. The VIX has calmed down, the volatility of the market, everything is leveling off right now. But we know that's not actually the case around us. And I feel like the government truly kind of screwed us here. And this is something that I've talked about many of times in the past about how they put band-aids on these problems to kick the bucket down the road. So, I mean, if you're one of these people like I was that collected the CERB here in Canada, or you're collecting benefit checks or the stimulus checks in the US, it seemed fun. You're like, hey, I'm going to make an extra few $1,000. In Canada here, they were handing out like $10,000, $20,000. And you're like, this is great. But now we're on the other side of this where it's starting to be like, holy crap, food's doubled, tripled in price, lumber. You're trying to buy fridges. I mean, our fridge at home is going out. My parents are petrified because fridges have gone up over twofold. Home appliances, it doesn't matter what you're doing. We're starting to feel the new end of hyperinflation here, and the Federal Reserve is starting to recognize it for what it is. They're claiming that they're going to be probably fast tracking the interest rates, and what that is about to do to the market, I think, is being underappreciated. Usually, the market tries to price in what the future may behold, and I don't think the market has started to price in anything to do with interest rates going up just yet. And you can take a look at what is it, FINRA.org, that shows you the margin rates, and margin continues to hit all-time highs month after month. Actually, I can tell you what the rate is right now because for the end of May, I think we saw about, what was it, 861 billion in margin just in the stock market alone. The month before that was 847 billion, and you go back to January where we were at 790 billion, which is pretty intense, considering if you go back to January of 2020, margin was only at 560 billion. So, I mean, we've seen a huge amount of people taking on massive amounts of leverage in the markets, but to an extent that's going to make a huge impact in the near term. I'm not 100% certain because a billion or getting close to a trillion in margin isn't necessarily that bad when the entire, markets are worth like $50 trillion plus. So, I mean, if we even wiped out all the margin debt, I don't think it would impact that as severely, but it's the underwritten debt that's in the market that you're not taking into consideration, because when you look at everything from Google to utilities to REITs, I mean, all these companies are living in a period where for the last decade we've had interest rates going down. And I've had this argument with my mother recently because my mom said, "Oh well, things have been great forever now. Things have been fine." She's like, "Even what's the big deal?" She's like, "You think housing prices are going to go down?" And I said, they might level off. I don't think we're going to see a huge impact to the downside. However, we've only been in a market where we've gotten really comfortable where every single year interest rates have gone down. So if interest rates go up 1, 2 percentage points, I don't know what that does to the general markets, but I know you're going to see that infliction hit every company on the balance sheet of these stocks. You're going to see it, I mean, on all the margin debt. You're going to see it on all the mortgage debt. Like it's going to ripple through the market, and I think it's going to be more impactful than people are anticipating. It's one of the primary reasons that I have been stacking cash. I hate holding cash, but it's just, I feel like we're in the eye of this storm right now, and it's just something that is not normal. And I don't know how it normalizes from here. I mean, in a perfect world, when we move forward from this, let's say the strawberry farmer who has marked up strawberries threefold now because of everything going up in value, that eventually another farmer is going to say, "Hey, I can do this for less 3 months down the road." So eventually we just start to see competition lower the inflated rates of goods, but we don't know exactly how all of this is going to come into fruition. I just know the Fed is starting to get a little itchy about it, and it's basically screwed everybody over that thought stimulus was a great idea. I was against stimulus. I took stimulus, but you just see how it negatively impacts everybody down the road. Because if you were somebody that was claiming any of these stimulus packages, there's a good chance that you're somebody that worked at a restaurant, you had student loans, you had some of these issues, right? And now, once you get to the other side of that, you're like, hey, maybe I want to work toward my retirement. Maybe I want to buy a house. Well, too bad, because of this hyperinflation through printing of money, asset prices have gone up twofold, 30% across the board this year on real estate, like insane numbers that things just keep coming out of the woodworks here. So it's like, hey, now if you want to retire, you're going to have to work 30% harder to own that house that you could have owned a year ago for 30% less. Hey, you want to retire off stocks? I mean, really, you're going to have to put double in what you had to even a year and a half ago to make the same amount of income off, say, dividends or, just buying growth stocks. So and I don't think we're going to head into a place where the markets are going to keep doing what they're doing forever. Obviously, I mean, we're going to head into a period where I think the markets could generally flatline. I just don't know, because there's been this massive pivot that's really pushed technology forward. And what I keep telling people that I think is fascinating is things like tech stocks are actually undervalued against the S&P 500. Somehow the S&P 500 is trading, I think, like a 44, 45 PE range, which is insane because we've never seen that except for the '08 crisis, the dot-com bubble, which, by the way, both of those periods in time, interest rates were exceptionally low. Money was flowing like candy. And it's so reminiscent, which is probably why we get people like Michael Burry, who's been drilling us about how we're in probably one of the biggest bubbles we've ever been in. But for every time I hear that, there's always another side of it. And to put that in perspective, when the S&P 500 is trading at a 44 PE, but you have the largest companies in the world like Apple, Microsoft, Google, Facebook, all trading at PEs between 28 to 33, 34 range, that's actually reasonable for the growth that they have behind them. The question, however, is the companies that are blowing up, driving those PE ratios through the roof, are they going to be able to sustain the growth rates they have? Because, like I said, it is great buying Google and Facebook here for as long as the growth rate sustains. But I'm starting to notice there's more government infliction on these companies. I talked about this a lot. Facebook and Google were the best companies in the world to work for. Why? No tax implications. There was no foreign income tax implications. There was no HST or GST here in Canada on goods and services. And literally, the second I start spouting this, not even a week ago, Facebook is now introducing GST and HST taxes to their services that you have to start calculating. Google, not even 3 or 4 months ago, started charging foreign income tax to people that weren't in the US. And this is only new. So these are going to hit the bottom lines of these companies progressively over time. But we're in this period where so many people have shifted to online that we're seeing 40, 50% revenue growth rates on their bottom lines, which is just crazy, right? So the big fear is if we hit a quarter where that slows down. If we see a slowdown in any of these tech companies' growth rates, and let's say it just drops in half for whatever reason, and that could be 6 months from now, that could be 12 months from now, that could be 2 years from now. But if we hit a brick wall anywhere along the way, the markets are they're going to tank. I mean, it's going to tank. But I don't know when we reach a max saturated market potential, because again, like, considering when you look at something like the internet, how many people have access to it? Because that's really the only thing holding back Google and Facebook. Like, how many people aren't accessing the internet right now? And unfortunately, that's a large percentage of the world. I think something like 40% of the world's population right now doesn't have access to internet. And that's something that Elon Musk is trying to change. I mean, we're seeing infrastructure across the board go up to try and solve these problems, because everybody knows that, you get people on the internet. There's a lot of companies that are going to benefit greatly from that, being telecommunication companies, obviously all the internet, any internet, Zoom, all those companies are going to benefit, right? So it's really hard to kind of to pinpoint exactly where we are in this market cycle, which is why I don't make predictions off of this. I just think it's fun to analyze it and just kind of, play this out in the near term just to see how things might unfold. And I'm hoping it's going to be gracefully. Crossing my fingers it's going to be gracefully, folks, because this, like I said, when the VIX hits the levels that it's hitting, considering how high the PE ratios are, and just it's such a weird, wonky market to understand that the only thing you can really do, like JT is saying, is buy things that make sense, like REITs. And the funny reason that REITs make sense is because they're using the hyperinflated moment as a ploy to get you to invest. I mean, go look at something like one that I've been looking at. What is it? Northview Properties. I got to remember. It's a new REIT that just came up in Canada, and in their investor presentation, they actually state that, hey guys, there's no competition anymore because nobody wants to build homes right now because you're not going to cash flow positively. I mean, trying to build a house right now with the lumber prices, and like I said, we just went out for a walk and you see all these construction sites that have started, but they're not doing anything because there's just no point. You might as well wait. There's just nothing to do but sit on your hands, right? And it's also neat too, looking at a lot of the real estate prices across the board right now, considering this is a statistic that I talk about a lot that I just don't understand. And eventually, this is going to matter a lot, especially in Canada. I don't know about the US specifically, but I feel like this is a broader conversation across the board. And that is that if you look at rental prices, they've actually dropped in Ontario, where I live in Canada. The entire across the board rental prices have come down, especially in Toronto. So when you see rental prices coming down in Toronto, I think they're about 17%. How does it make any sense that the value of real estate went up 30% in the last year, but rental rates went down 17%? Because the whole point is when you're buying a property, especially a rental property, is it has to positively cash flow. And you're never going to do that with a minimum down payment today. Like you're going to have to come up with at least six figures to positively cash flow a property. And especially considering interest rates are at all-time lows, but you can really only lock those in for certain periods of time. And when we know we're heading into a market where the interest rates are going to go up, it just doesn't make sense. Like none of that makes sense for the real estate market. And I don't want to say a real estate market crash is coming, but a cooling period has to be on the horizon. Because again, guys, you can't positively cash flow. You need absurdly high down payments, and interest rates are rock bottom. And I know everyone's like, yeah, but if things have been fine. It's like for the last decade, yes. When interest rates go down for 10 years, it is a great market to be in. But when you're at rock bottom prices where people over leverage, and we know from here it's only up, and we're going to go up a lot faster than we were going to anticipate, according to Jerome Powell, I would be cautious. I would just be real cautious about how you're living your life in the next 6 to 12 months, because I am just sitting on my hands, not trying to do anything too aggressively. Talk about this with my parents about buying certain things, and just like we're cutting back on food. I mean, we're not buying strawberries. We used to go strawberry picking every year, and it's just this is a year where you're not going to want to go strawberry picking, where you're just not going to want to do the normal things you did, because it's just going to cost way too much. So I mean, that's kind of where we're sitting right now, and it's fascinating and interesting all at the same time. Let's see what we guys got for any questions. This is just going to be a quick video today, folks, and I just wanted to hear how hyperinflation and interest rates may affect your personal life. Have you gone out and see hyperinflation somewhere affecting your own life? I would love to hear about it personally, to have a quick conversation. My guess is that when interest rates initially dropped, a lot of renters decided it was time to buy. So lack of demand for rent brought rent down. I would agree with that. And a lot of people, even in Canada, are moving out of the cities because they don't want to live in condos. They want to work from home and have a decent space to live in. Because if you're not living downtown to stay in your apartment, I know that for sure. So I mean, obviously, there's so many people moving out of condos that it's a good reason that we're seeing a drop in the condo market prices. But what's better, buying with cash or a mortgage? This is a debatable question, to buy with cash or to mortgage the property, because I know a lot of big realtors, people like Grant Cardone, are always going to tell you to, always cash out, refinance, buy that next rental property. But I'm kind of more of a Dave Ramsey guy, if I'm honest. I'm a kind of a person that if I could buy a condo or a rental property with cash, I would rather do that, because the cash flow is going to be insane, first of all, and you can leverage it down the road if you really wanted to. But having no interest payments and 100% cash flow positive property, like I look at condos and I'm like, if I could put, say, a quarter mil down on a $500,000 condo, the cash flow I'm going to get off that is likely going to be it's 7 to 8 cap, which is going to be incredible. And it's just, I don't know. I'm just one of these people that doesn't like debt. And if I can afford and then the condos have too much maintenance. How do they have too much maintenance? You have maintenance fees, but I mean that's dictated based on what you know about the condo and who's done the math on what the condo fees are going to be. See, I'd rather do condo rental units. You don't get the upside as you do on real estate, like physical rent or residential real estate. But the thing with condos is you don't have to deal with toilets, you don't have to deal with roof repairs, cutting the lawn, because you're picking up the phone all the time. If you rent a condo out and it's cash flowing an 8 to 10 cap, which again takes a big down payment, is incredible. It's just pure cash flow, that requires hardly any in you in getting involved. It's just great. Went to buy Walmart today and saw that Jason was buying his tickets. Well, just kidding. Oh, for what are we talking about there with Jason? I don't know. I'm just trying to read through your comments real quick, guys. What do you think of Beyond Meat? Honestly, I think the meat market is going to change drastically. I was watching a few predictions, people's 10 to 15-year predictions, and I thought they were relatively entertaining, because one of them is the meat and milk market is going to change drastically. You're going to see soy milk start replacing regular milk. You're going to start seeing artificial meats, lab meats. You're going to start seeing companies like Beyond Meat, vegetarian meats start to populate in, I think, honestly take over, because if you believe in global warming by any stretch of your imagination, which at this point it's almost hard to not believe in global warming when when you just look across the board what's happening. I mean, I just like the Elon Musk stuff, right? Like we're heading into a period where if we don't figure out how to fix these problems that we're causing now, it's our kids that are going to potentially have to answer to some serious life problems. Like, I mean, we're born in a time period where we're so fortunate, because any time period, like, I mean, this is what I joke about too. Like, if you ever watch westerns or any old movie that's based on like the 1800s or 1700s, they're almost laughable because they're all old people with big mustaches. Did you know the life expectancy before the 18, like going into the even just going into the early 1900s, was only 34 years old? So, I mean, we're living exceptionally longer than we used to, but we're living in a period that has been very graceful, considering we've had no major pandemics, even though this one isn't nearly anywhere close to the Black Plague. We're not living in a period where we're having a lot of volcanoes or other issues that would cause higher carbon emissions to the planet that causes weather fluctuations. Honestly, we're our biggest enemy right now. So when it comes to a lot of that infliction, when you talk about fresh water, sustainable food, which if you don't believe global warming exists, go look at the wineries. Wine prices are going up this year, and it's not just because of hyperinflation. It's purely because of the weather fluctuations are so crazy that they've lost major crops. And we see it personally as farmers. I mean, we've seen crazy. I mean, to put it in perspective, guys, we got frost that was unexpected, and I've watched it wipe out $10,000, $20,000 worth of crops on farmers already. So I mean, it's again, it's kind of an interesting debate, but I think it's kind of insane not to think that global warming is going to change the way we make our food, because cattle causes one of the major food meat production in general is one of the major carbon emitters, right? Try not to think about my kids' future. They are screwed. Makes me sad. At least all with all this AI and automation, hopefully they won't have to work much. Yeah. See, I feel like we're going to be, if we don't figure out what the problems are now and resolve them, we're going to cross the path of no return. And if we cross the path of no return, then I feel like might not be our generation or our kids' generation, but definitely our kids are going to be answering to some major human life expectancy problems. And I think we're going to get contained into like living on Mars. I honestly think we'll build containments, and you just won't go outside that much for whatever reason, because the weather situation and just the constant changes to the way our food and our environment is going to change is going to be intense, because we're already growing food in containers. I mean, they're trying to do container food, and I think that's the way the world's going to head, because it's hard to say we're not going to destroy most of the planet by then. So like I said, enjoy the time period you're born in, because trust me, we are unbelievably lucky. Any other time period sucked in the last century, the last 2,000 years. Things have not been too favorable for people that stub their toes and don't have antibiotics, and die from simple things like, I don't know. This is a whole different conversation in and of itself, right? What's your take on Standard Lithium Limited? I have not looked into Standard Lithium Limited, but if it has anything to do with this is something that I'm talking about in the coming weeks with some sponsored videos, is the exploration of copper, exploration of lithium, graphene, gold, precious metals. I mean, would you look at how much copper is used in electric vehicles, solar, anything energy related, anything electricity related for that matter? There is going to be a race right now for minerals, and it's not even these companies. They don't even want to own or mine the properties. They Not that they don't want to own them, they don't want to mine them. They just want to find the deposits and capture them, and then just own the mineral rights, because eventually somebody's going to pay a fat premium for that, and we know that's the world we're headed to. I mean, like, this is the big thing with Tesla, right? Everyone's like, well, if Tesla's going to own the battery market, why aren't they partnering with all these other automakers? Why aren't they sharing the technology? Well, because the problem is there's not enough batteries. Tesla has a battery. They know they're heading to a battery shortage in the next 2 years. I mean, people on the horizon, things are going to get very technical and very complicated when we're talking about minerals and just precious metals in general. It's going to be a fascinating ordeal, and I think honestly, space travel is going to mitigate a lot of this. I think once we get into space and it becomes feasible to mine mining capabilities on the moon or just asteroids, I think that's going to change a lot. But until we get to that level, I would really keep an eye on exploration stocks, because things are going to get very, very intense. Artificial meat is disgusting. It still has a long way to go. I would agree, but unfortunately, it's the way the world's headed. It just is. If it doesn't head that way, we're going to head into a much worse situation in the long term. What else we got going on here? Been going through your back catalog of videos and enjoy them. Thanks for being constructive. My portfolio the last few months in dividend stocks. Yep. Yeah, for sure. I appreciate you taking a look at some of my videos. I've been very diligent on what I've been buying lately. What do you think about the stocks for dividends? Start of your portfolio, TD, TU, Algonquin Power, Enbridge, Manulife. I haven't looked into as much. I'm not a fan of insurance companies because I just don't understand them that well. CNI, I'm not sure if that's the CN Rail, and then you got Ryokan in there as well. Yeah, I was more inclined to buy into the banks a year ago. Right now, guys, I don't know what to say because a lot of people new to the market are like, "Hey, banks are great. Buy the banks." The problem is the banks just hit all-time highs. And I know right now when everything is just going up, which again, if interest rates go up, it only helps the banks. But when we're heading into a period where things only go up, I want to remind you guys that the banks, go look at Canadian Imperial Bank, go look at Bank of Nova Scotia. These banks flatlined for almost 5 years. I was buying Bank of Nova Scotia when I first started investing, like within the first 2 years. I mean, I've been holding BNS for 4, 5 years or something like that, and it did not show any capital gains until this year. And I just don't think people understand that sometimes these companies they're attractive when they're going up, but if they go the other way for whatever reason, they could flatline for a very long period of time. And I think people get very turned off by that. And especially when you're buying them when the dividend is at the lowest rate that you might be able to capture. And yeah, they are sturdy. I love owning them, but I wouldn't say build your entire position out right now. If I was buying the banks today, the REITs today, just take it easy. I like Algonquin Power here because it's trading 16% off its highs. Great dividend increases. I mean, a compounded rate of dividend growth of over doubling every 10 years. Really great. I still love Apple here. I know a lot of people are against Apple. They always are against Apple for whatever reasons, but I think Tim Cook is going to leave a legacy of healthcare. I don't know what it is because I never cared for Fitbit. I never cared for any of that. But if there's one thing I do a lot, it is definitely check my health through the Apple app. And I mean, there's been so many stories lately of people not understanding underlying health issues just from some of the stuff that has to do with the Apple Watch. And I mean, I check my steps all the time. And I've never done this before until I got into like the iPhone health stuff. So I think Tim Cook's legacy to Apple is going to be something highly related to health. And to the ecosystem of Apple is incredible. It's the greatest dividend stock of all time. I mean, it truly is a marvel, right? Waste Management, Walmart, Procter and Gamble, Johnson and Johnson, all great companies. But again, I would potentially at this point cost average in rather than dumping a large sum because I just feel like the markets are unpredictable right now, and I'm just not in a rush. Like I said, I've stacked almost. I'm trying to keep about a 5 to 10% weighting in cash, not a huge amount of cash against my portfolio, obviously, but just enough that if an opportunity arises, I can really pounce on it. POW, my best performing stock by a mile right now. Here's what we're going to do, folks. If you have any other questions, because maybe I can relate the hyperinflation and the interest rates more to your stock portfolios and just kind of how I feel about it. But I want to come back. I'm going to do a live stream tomorrow as well, probably around noon time. And I'm going to get more in depth where we can talk about stocks and kind of go over these stock picks like in depthly if you'd like. But I just wanted to keep this video kind of pure just to talk about just the hyper rate of inflation and interest rates because too many people have overlooked it. And it's like I said, it's easy to overlook when we've had 10 years of great interest rates going down. But like I said, margins are at exceptional highs. Please take some time and just look at the history of crashes through finra.org, FINRA. That's the margin statistics against the stock market. They are at all-time highs, and they keep going up every month, even though we know interest rates are going to go up. We are not trying to fight deflation. Like I said, it's one of these moments where the Fed's now done printing money, guys. The U.S. dollar has slightly come back a little bit, and it should strengthen the U.S. dollar when interest rates go up. My fear, however, is the same thing Michael Burry is talking about, that there is an exceptionally large amount of margin debt across the board, whether it's credit card, line of credit debt, Bitcoin debt. We don't even know what the debt is in crypto. We don't. It's a little bit sketchy. The markets are in a sketchy place, and I'm just like I said, it's just one of those things where we could see a quick flush, and the markets could easily do a 15% correction from here. I mean, I could easily see it. It just seems so unusual for things to just keep climbing forever. at the rate they're climbing. Because again, guys, Google's up 40% this year. And yeah, they crushed 50% earnings growth. But my God, is that just something that's related to the pandemic? Or is that something that's going to continue for the next year, 2 years? Or do we see a slowdown period? Because like I said, if anything, for any reason, takes one quarter of hiccup where things just drop and we see a growth rate drop slightly, I swear the markets are just going to take that for the worst. And you're just going to see a mass exodus of some of these companies. And then we start seeing PE ratios start dropping. Because like I said, guys, PE ratios have gone up month over month. Margin debt has gone up month over month. Everything that is not good in the market just keeps going up. So be fearful when those are greedy, right? And be greedy when those are fearful. And right now, there's a lot of greed going on. So I'm just cautiously optimistic. Of course, long term, I hold all my stocks long term. I just wouldn't be inclined to just like if you had a lot of money, I just wouldn't be inclined to throw it all in at once here. Because like I said, there's nothing saying that in the near term we can't slow down. Any good high yield saving accounts? Like this is the funny thing. When if you go back a year and a half ago, I was getting 2% interest rates from my savings accounts, 1.5 to 2%. Literally within a year, when interest rates hit almost zero, my interest rate now is 0.5%. That's the best return I can get from any bank in the long run. In the short run, usually they'll offer you like 1% at most, but the only people that I know that are offering like compounded significant returns on, and they're still 0.5% is like Wealth Simple. There's a few high interest savings accounts where they pay you the 0.5%, but they pay it to you monthly and then they reinvest that for you. So every like let's say you have that money in Wealth Simple, $1,000, they're going to pay you 0.5% paid out monthly, but every month it recompounds. So whatever they pay you that month will also compound at the 0.5% rate. So that kind of works a little better, whereas the banks aren't the same. I think the banks operate a little differently. Love your show. I appreciate you coming out work less. Enjoy life more. Yeah, I really appreciate that comment actually because I kind of like doing these off the cuff. Just streamline consciousness conversations because I feel like when I just start ranting about stuff, I feel like I can just really kind of get the picture across of what I'm trying to have a conversation with. And I love when you guys kind of throw stuff back at me as well. I think it makes the conversation a lot more interesting. So here's what we're going to do, folks. I'm going to finish it up here. Just wanted to have a quick convo today. And what we'll do is we'll come back tomorrow at noon. If you get some time, pop in, go enjoy the soccer game. The soccer game's on right now for anybody in soccer. Take it easy. It's a nice long weekend. Weather's beautiful here. And we'll come back tomorrow, sit down, and we'll specifically talk about stocks because, oh my God, there's a lot to talk about with stocks right now for sure. I got a lot of small cap plays that I haven't bought into, but they're definitely on my mind. But I'll catch you guys tomorrow, and we'll try and shoot for between 12. We'll try and shoot for around 12 o'clock. So stay cool, stay awesome, folks. I look forward to catching you tomorrow. Peace.